Good morning and welcome to Real Estate Economics webinar series. I'm John Mulville and I'll be presenting Phoenix, Arizona Economic and Housing Market Forecast. We're going to spend quite a bit of time looking at the employment picture, both national and state today, so let's get started here. Obviously, the thing that jumps off the page in this particular table is the losses in government employment. Almost everyone has heard about the Federal Reserve's quantitative easing program, QE1 and QE2, but much less well known was the American Recovery and Reinvestment Act that provided $400 billion in federal stimulus dollars that went out to the state and municipalities. On a national average, the states have been relying for about 30% of their budgets on national stimulus. Over the past 10 years, local government spending has increased 65%, while at the same time their revenues have only expanded by 32%. The various states and municipalities across the nation now are estimated to have about $1.3 trillion in off-balance sheet debt, much of that being pensions. It's often in the news these days. But now that the American Recovery and Reinvestment Act isn't providing as much money to the states, you can start to see the employment losses in government. The government sector was able to avoid its financial day of reckoning through 2008, through 2009, through 2010, largely in part to this stimulus. But since states and localities must have balanced budgets, the real economic drag is finally coming home to the government sector. If you look at the rest of the economy, by and large there are job gains in many areas. Leisure and hospitality is growing quite robustly here. Educational and health services has been doing quite well. This is actually a fairly low number there. Professional and business services, almost 600,000 jobs. Even the very much beaten down construction sector added 314,000 jobs from July 2010. Let's make a comparison of what this looked like a full year ago. This is the 1 year ago data, July 2010, and you can see huge losses in construction, big losses in manufacturing that have been largely reversed. Manufacturing has been one of the bright spots in the economy the last year or two, with a very beaten down U.S. dollar. Our exports are much more appealing overseas, as are our agricultural products. Trade, transportation, and utilities has reversed its job losses. Information has reversed its job losses, and we're still having some weakness in the financial sector with all the pressure that's on the banking sector today. But compare that to 2011, we've had a huge improvement in the past year, with really the government sector masking or offsetting growth in many of the other areas. Let's come down and look at the same data for Phoenix, the Phoenix MSA. You can see government sector is again taking hits here, but the rest of the economy, by and large, is doing at least okay. We've got growth in a lot of areas, big growth in educational and health services, good growth in trade, transportation, and utilities, construction, manufacturing are all adding some jobs. The losses in government aren't completely wiping out the net gains, but there is bound to be numerous more months, possibly years, of declines in the government sector. If you look at 2010, 1 year ago data for the Phoenix MSA, you can see construction was still drawing down quite extensively at this point, and there was losses in nearly every other sector. So we really have seen a transition from a year ago, 2010 data, to 2011 data, with a widespread improvement over a lot of industries. Slow, but the big story is a slow, steady improvement in most industries, with government really being the laggard at this point in time. Year over year employment growth for this MSA, you can see after a very bad 2008, a trough in 2009, some gradual improvement, though with continued losses in 2010. By the time we get to 2011, we're seeing year over year improvement in the data so far, and our expectation is that that should probably continue. We're going to have some soft data probably come in for The August numbers, we'll have to see how that plays out, but we've generally got an improved employment picture in this particular state. The right-to-work states and states with friendly business laws and employment laws have been benefiting. There's just no doubt about it. The companies are preferring to locate in places with business-friendly environments and are leaving the many states that have high regulatory climates, bad labor law conditions, that sort of thing. 12-month change showing another way. This particular area lost roughly 225,000 jobs in 08, 09, and 2010. We've got an estimate of about 22,000 growth for 2011. So it's going to take several years to recapture the sum total of losses that took place in 08, 09, and 2010. Here's the annual employment. You can see the peak here, 2007, when this area had about 1.9 million jobs at its peak. Much of that, as you can see, came with subprime and was construction related. Not just building, but escrow officers and title officers and appraisers and inspectors and people who work at the utilities and the municipalities. So this boom in construction that came with subprime really reached into many areas of the economy, and this area added a lot of jobs. Those are dwindling back down now, and it's going to take all the way out till 2015 before we get to that previous high water mark in terms of employment at about 1.916 million jobs. And at that point, we should be able to start to see some real improvement in the housing market. We'll talk to that in another slide. As you can see, this is an area that's traditionally produced about 25 to maybe 30,000 employments permits annually, going back all the way to 1993. If you look at the current numbers, 8,000, 7,000, 9,000 almost projected for 2013. Those are numbers that we haven't seen in the whole entire data series going back to 1991. In 1991, the job base in this area was only about 1 million compared to 1.7 million now, so we're producing fewer houses for a employment base that's much, much larger. Generally, permits of this low level aren't sufficient to replace units that are torn down, get burned down, converted to other uses, however they exit the system. It's usually in numbers greater than this. So what's happening to the overall housing stock is it is aging right underneath us. Until we can produce some more inventory in the outer years, the housing stock is really just going to continue to depreciate. When the market does start to show some vibrancy in the out years, those new homes that are produced in 2016 are going to look a lot different than the last boom of 2006 and 2007. There'll be a full 10 years age difference there. So when we finally get there, there will be tremendous opportunities in new homes, and the older resale homes are not going to look and feel the same in terms of technology and energy efficiency, and there will be tremendous new home opportunities at that point in time. Here we've put together the new home, the permits, plus the distressed inventory, so you can see how this plays out. In 2005, it was literally all new construction with huge numbers, over 60,000 units, and that has drawn down significantly into the 7,000 or 8,000 units a year we just saw in the last slide. Overall availability, though, is nearly double that by the time you add the distressed in. Now, the distressed is really starting to draw down in this market and many markets nationally. In part, the banks are a little bit slow. The lenders are a little bit slow at this time, but the notices of default are also coming off. A lot of people have had their option arms reset, have had their subprime loans reset, and have moved on. And so those numbers, the numbers that are in the pipeline, should be drawing down through the balance of 2011 into 2012. And everyone who's got a reset or got some sort of payment adjustment should have had that experience within another year or two. And that should really be putting us towards the end of high levels of new distress, assuming we get some economic growth. This particular chart shows the various types of distress in this market. NOD, notices of default, that's usually 90 days delinquent, are in blue. Foreclosures are in red, and foreclosure sales are in green. As you can see, the NODs, notices of default, spiked up very quickly and have been trending down ever since. Equally important here is that foreclosure sales are exceeding foreclosures as far back as 2009. So this gradually takes away shadow inventory and keeps the inventory from building, really far out of control. Now we've been seeing some numbers for this MSA that the distress unit totals are coming way down. Overall listings are way down in this particular market area. So we're starting to see this process wind itself down. Now the way government involvement and suing the lenders over the mortgage-backed securities, that sort of thing, that's going to take a few years to play out. So this problem is going to be with us, but you can start to make the case that a lot of this is behind us and that we should be able to see the light at the end of the tunnel over the next several years. Let's look at housing market demand and supply. The supply of housing is shown in blue. Almost any area we work in, it's reasonably difficult to acquire land, get a loan, design a product, finance it, build it, and get new supply into the market. It takes time, it's very labor intensive, capital intensive, and prone to all sorts of risks. So the supply of housing in almost all areas tends to grow pretty slowly. If you look at the current years from about 2009 to 2014 or 15, that blue line is almost completely flat, indicating a near stagnant supply side of the equation with very limited new growth over a 5 or 6 or 7 year time horizon. By comparison, the green line, the demand for housing, tends to oscillate quite a bit. It's primarily a function of employment. When the employment market is vibrant and people can get jobs, the demand for housing runs up, as you can see, into 2000 and again into 2007 and 2008. That demand ramps way up, and when we have a recession, an economic contraction like you see in 08, 09, 2010, then that demand comes way down. What has happened in this market and many of the markets we work in is the current housing stock is essentially too large for the employment market. There are too many homes compared to the number of jobs. That's what leads to abundant listings, abundant for sale activity, and draws down quite a bit on prices. As you can see, we're expecting to be back to a statistical equilibrium in 2014 when the jobs again start to match up a little bit better with the housing stock. Housing valuation. For many years, median home prices were well aligned with what they should have been, because there was loan underwriters. I mean, people had to qualify for a loan. You had to prove you could pay it back. There was an extensive process, and when the underwriting book went out the window with subprime, you can see this big spike right in the middle here. When you could suddenly get a loan for whatever amount that had no connection with what you could truly pay back, the only place for that excess demand to go is into house prices. So house prices skyrocket, jumping up literally about 120,000 just in a year or two, and now obviously we're paying that back. There's more than a correction. We've got a severe overcorrection taking place and evident on the ground here in 2011. You can see where the blue line is far below the green line. That's undervaluation. The market is hugely undervalued at this point based on long-standing and time-tested relationships between people's income and what they'll pay for housing. Over time, this will come together and incomes and values will reacquaint themselves, but at present the undervaluation is severe. People will say to us, well, if the undervaluation is so great, how come people aren't out there scooping up houses right and left? And our answer to that is, well, in many ways they are. Rental investors and people with money who want to invest in a home, rent it out for a few years, and resell it 5 or 6 or 10 years down the road, have been very busy in the market. Many of the areas we work in have 20 to 30 to 40% all cash sales. And typically it's been that rental investor who brings the all-cash offer to these deals to try to strengthen their hand in negotiations. Here's another way we look at housing over and under valuation. You can see in the 06, 07, 08 period that the market was overvalued by these historic relationships of income to house prices by as much as $100,000 in 2006 and 2007, only to reverse and find its way to a tremendous undervaluation as early as January of 09. That undervaluation continues today, but is gradually going to mitigate itself over the next few years of the forecast, and we should be back to sort of price equilibrium, which tends not to last very long, frankly, by 2016 or 2017. Let's look at median home prices in this market. You can see the consequence of subprime here in 2005 when the values literally jumped from the mid 150s up to the mid to higher 200s, only to come all the way back down to what is about a 2002 or 2003 price range. Let's look at our current red line here. 2011 we're at 132,000 median, and that would have to take us all the way back to about year 2000 for an equivalent comparison. Let's look at the high year of our forecast, 2016. By 2016 we are still going to be somewhat below 2004 levels, and it may be many years before these high numbers are erased. Now, one of the things that happens is anyone who's managed to stay in their home with above market acquisition costs, as the market begins to trend higher, they're going to want to sell. If you're in at 250 and the market finally gets at 250, you're going to say, I've been here 10 years, I have other job opportunities, other life changes, it's time for me to move. So there is going to be a just plentiful overhead supply coming out over the next few years, and every time we reach a new threshold, buyers are going to emerge and react. So sudden reversal to a healthy housing market is some years off, because there are people trapped in their homes, financially trapped in their homes, that are going to look to exit when the conditions are favorable. So we like to look at, part of that whole equation, we like to look at rent versus own dynamics. Shown in the pink line is the mortgage cost. Now that's 80% loan to value. We know a lot of people aren't putting 80% loan to value, and this also doesn't factor in taxes and insurance and that sort of thing. So the pink line is really probably understating the true cost of home ownership, and if that number was higher, it would suggest that renting is still a good deal at current values. But then what if you factored in mortgage interest deduction? That might offset that. Many people deduct their real estate taxes, that sort of thing. So there's a variety of issues here that come into this equation, but the point is that it is very inexpensive to own compared to 2006 and 2007 and to historical standards. And that obviously the functionality of your home is typically much better than even a Class A REIT quality apartment. Let's look at the trends in this particular area of vacancy. Vacancies were up in the 15% range in 2009, but are starting a long drawdown process that really is a precursor to higher rental rates. We've got rents increasing across the country that we can see, and in most of the markets where there's any sort of good job creation, the rent increases have gotten sizable, almost outlandish in a few places. So we don't really see that taking place here, but we've got a long, steady drawdown in vacancy that's going to give landlords the opportunity to raise their rents a little bit. So let's look at the conclusions and what we think about this area overall. We know that listing inventories are very low in this market. As you move from market area to market area around the Phoenix MSA, the listings, when we reviewed it, are half of what they were a year or two ago in many places. 2/3 was about the best number we saw. So there's just a considerable drawdown in available homes. Levels of distress are still high. A lot of that inventory is distressed or short sales, but those are trending lower. We saw that earlier in the presentation. Interest rates are heading still lower from here. What they're talking about as far as the new QE3, if you will, is purchasing more long-dated bonds. That should push down the long end. The high number of the yield curve, the 20-year rates, 30-year rates, and so far the spread between treasuries and mortgage-backed securities has been increasing. So if we could get a little reversal of spread there and lower rates, suddenly rates could be considerably lower than they are even at today's low numbers. We're a little bit concerned to report that the probability of another recession is pretty high here. If you look at credit spreads and some of the data coming out of the Institute of Supply Management and a whole bunch of the leading indicators don't look very good now. And we're probably going to have a soft series coming out in August, even worse than the July series. So there's a significant chance here that we've got another recession on our hands. It's hard to see if that's better or worse than the last one. Obviously, the banking sector is not tipping, into collapse like it was in 2008. But at the same time, European banks are severely undercapitalized. Many of the European nations have very serious and have problems that are probably not solvable. Greece is going to default, let's face it. At the same time, around the U.S., buyer mobility and employee mobility is really improving. Most people are coming off their 99 maximum weeks you can get in many states and cities, and they're starting to expand their search for jobs. The mobility in this past recession in 2008 and 2009 was much lower than it typically is in most recessions, and that is just really starting to reverse here. So we think people are becoming motivated to improve their search and really consider going where they have to go to find employment. Simultaneously, corporate mobility is very high. Companies are very focused on what are good states to locate in, and if they can't move their whole operation, they move big pieces of their operation into states that have friendly business climates and out of places that don't have friendly climates. There's stories in the news every single day about this, where corporate relocations are taking place, and they're doing a careful analysis of what states they should be in and what states they should avoid. Well, thank you for joining us today. At any time, you can see our webinar schedule at www.realestateeconomics.com. We post the webinars typically Wednesday at 9 a.m. You can watch those at your convenience. Go into YouTube, Real Estate Economics. Then you can see all of our past webinars, and you can select the one to watch or listen to at your leisure. You can go back and find the parts that interest you. You can move around market to market. We do special topics from time to time, as well as covering an MSA like we did today. Thanks again. I'm John Mulville. If you have any questions about today's webinar, you'd like to call us about anything relating to the housing market or the general housing market economy, please do. Here's my contact information. And please join us for our upcoming webinars.